Hey guys, so picking up from where we left off in the last video, we were talking about amortizing a bond discount and how we went about doing it. What I want to make sure we understand that we're capturing is we have to recognize the issuance of the bond. We also need to capture the interest that we're going to pay to our investors. We're also capturing the fact that, hey, we did not get the full amount of our bond, so we're capturing the interest expense related to the discount. And then last but not least, we're gonna capture paying off that bond. Okay, so what I want to do for a second is maybe on this just show maybe the steps. So the first one is we're going to capture the issuance. Come on. Okay. All right. First, we're going to capture the issuance of the bond, whether it's for a premium or a discount, right? Or discount or the face amount, right? And then next, we're going to try to capture, if it's done at a premium or discount, we need to capture, well, let me back up. So then once we record the issuance, we need to take into account the interest that we must pay to our investors. Okay, they're not gonna just loan you money because they like you. Then we also need to take into account the interest expense maybe that we need to capture for if it's a discount or a premium. And then lastly, we need to capture if there is, when we repay the bond, okay? Those are usually your journal entries. Now, if you are issuing a bond at face amount, come on, there we go. It's not liking my pen, but okay. There you go. If you issue a bond at face amount, you will only have the issuance, you will have the interest payment to the investor, and then you will have the repayment. You will not have this step because there is no premium or discount amount, the premium or a discount that you need to account for, right? However, if you have a premium or a discount, you're doing all 4 steps, okay? So I want to make sure you understand that concept. All right. So also in this particular instance, if we're following this example from the very beginning, if I can just humor you for a second, let's capture this from the very, very beginning. At issuance, the interest payments, and also the interest payments to the investors, the interest to amortize the bond, and the payment of the bond. Okay, so that's what I'm now going to capture in this next part. So step 1, again, we're going to do issuance, right? So if I can put A here, I'm going to do the issuance of this bond. So maybe take a second and go back to the last slide and you can see me capture this. But we're going to do a debit to cash in the amount of 96,000, what was it? 96,406, right? And then we have the discount because we didn't get the full amount, right? The discount on bonds payable, and that's in the amount of 3,594. And then we create the liability of bonds payable for the $100,000. Okay. Now we're going to capture the interest payment to the investors, right? And so we've already looked at that. So maybe go back a couple of slides and we're going to do a debit to, oopsie. We're going to do a debit to interest expense in the amount of $6,000, right? Because this is semi-annually. And then our credit is to cash, right? This is for the investor. Okay. Now, C, we're going to capture us amortizing the bond discount. And remember, we're going to do the 3,594. We're going to amortize it twice a year over the lifetime of the bond, which is 5 years. So that is going to be 10, and that's our denominator, right? So our amortized amount per semi-annual, right, it's going to be $359.40. Whatever, you get what I'm saying. All right, so to capture that, that's going to be interest expense in the amount of $359.40, and then my credit is going to be to the discount on bonds payable of $359.40. And then lastly, we're now going to capture, sorry, I'm going to put this as the discount. And then lastly, we're going to capture the repayment. And the repayment is going to be a credit to bonds payable of the full amount of $100,000. And then my credit is going to be to cash. I'm running out of space, but. Now, before I move on, I just want to make sure you guys know that these two journal entries will happen constantly, consistent, twice a year, every year for the next 5 years of the bond. Okay, so that's very important. You will see this every June 30th and December 31st, okay? And then at the very end on year 5, this will be your journal entry to capture the repayment of the bond, okay? So hopefully that all makes sense. Now, the last thing I want to make sure you understand is in Cengage, if you're doing your homework, it will not give you, well, a best practice, I should say. The best practice is to combine both B and C journal entries together because there's some commonality between them. You have 2 debits of interest expense, and then you have, cash and bonds payable. So in Cengage, it's going to ask you to combine these 2 journal entries together. All right. So that's what this particular journal entry does. It is combining your interest expense together, and then your credits is your discount on bonds payable and cash. Okay. So I don't want you guys to think that, oh, there's some kind of magic. No, all we did was combine our 2 interest expenses together, and then we had 2 separate credits amounts and accounts, which was the discount on bonds payable and the cash. Okay. So now with that, we're going to take a break and now go to the next video and do a breakout session. And if you're following along, this is example number 2. So I look forward to seeing you guys in the next video.